Hi, good day, and welcome to our webinar entitled Unraveling the Mystery of 1033 Exchanges. My name is Bill Exeter. I'm the Chief Executive Officer for Exeter 1031 Exchange Services and Exeter Trust Company. And first and foremost, our thoughts and our prayers go out to those who have suffered from all of the recent natural disasters, most recently all the fires in Southern California, and especially in Los Angeles. And this webinar today is really our public service announcement on different tax issues they need to be concerned about and how they might be able to address those. So with that, let's get started. First of all, the 1033 exchange. You may have heard of the 1031 exchange. That applies to the sale and exchange of rental, investment, or business use property. This is similar but different. This is the 1033 exchange, named after Section 1033 of the tax code. And it's really designed to help those who have lost property through what we call an involuntary conversion or taking of the property. The involuntary conversion can be one of two scenarios. In a lot of cases, it'll be an eminent domain, and an eminent domain is where the government takes your property. Generally, they take your property for the public good. Maybe they need to, add on-ramps or off-ramps for a freeway or widen a freeway. Maybe they need to take property to expand a school system or school building, things like that. But it's for the public good. The second area is natural disasters. So, you lose your property through a fire, flood, hurricane, tornado, something like that. It's a casualty loss. And that's also something that can be deferred through a 1033 exchange transaction. So these are all about deferring taxes that are triggered because you've gone through an involuntary conversion. The frustrating part is there's very little guidance on 1033 exchange transactions. So it's difficult to get information on how you can apply the 1033 exchange. And that's one of the reasons we offer this public broadcast service today, is to bring some of this information out to the public who have gone through some horrific experiences. So first off, involuntary conversion through eminent domain or government taking. It's effectively when the government takes your property using the eminent domain authority. They'll take it because they need the property for the public good. Again, that might be, a school district, it might be a freeway access or other public facilities or buildings that are needed, things like that. And it's generally taken through legal actions. They actually file an eminent domain action and literally take your property. They'll tell you what the property is worth. Most important thing there is do not necessarily just take the price they give you. If it's not a fair price, there are ways to, really discuss that, or I guess fight the fight with the government and get the price that is a fair price. So in that case, you want to hire tax counsel who can work with you in negotiating with the government, etc. But the other possibility is they don't actually have to go through the taking with the eminent domain action. They could actually threaten you with eminent domain. So you might be selling property to a government agency, and that government agency might have eminent domain authority. And in this case, you may want to say, would you threaten me with eminent domain action? In other words, maybe you've agreed to sell the property, you've agreed on the price, etc. So it's just a regular buy-sell arrangement, but you'd like to qualify for 1033 tax-deferred exchange treatment. So in that case, all you have to do is prove that the government agency threatened you. And in a lot of cases, they're willing to do that because it helps you. So it might be something where they build it into the purchase and sale agreement and say something like, we're buying the property from you, you are selling the property to us. If you fail to sell the property to us, if you fail to close on the sale, we are going to take your property through eminent domain. It can't be wishy-washy. It has to be an actual threat that if you can't sell or don't sell the property, they are going to take your property. In that case, you would still qualify for 1033 exchange treatment, which allows you to defer the tax consequences when your property is taken. The other area is when you get into involuntary conversions by natural disaster. So in this case, we're going to use the LA fire victims as an example in a lot of cases through the webinar today. So the property has been taken either by a complete destruction or partial destruction from a natural disaster. So it's an involuntary conversion or a casualty loss. And in this case, because of the horrible fires up in Los Angeles. And the property might be completely destroyed or maybe only partially destroyed. And when you're working with a natural disaster, typically the building or structures are destroyed, but the land is not. The land is still there. So you'll file a claim with your insurance company, and the insurance company appoints an insurance company adjuster. They're going to come out and look at the property, et cetera, evaluate it, then pay off the claim. When you get that claim check, that's effectively just like the sale of property. It's sale proceeds, if you will, and it's taxable. Now, in most cases, people are going to take that check and they probably repair or rebuild the property that was destroyed by the natural disaster. That's actually a 1033 exchange transaction. You have reinvested and deferred your taxes from the proceeds by rebuilding or repairing the property that was destroyed. Either qualify, but some people say, I don't want to rebuild, I don't want to stay with the property. In a lot of cases, it's very emotional, it's very traumatic. So they may say, I want to go and buy another property as the replacement property, and that can also work. So either way, whether you rebuild or repair, or you go out and buy another property, you could defer the taxes through a 1033 exchange transaction. And I know it's scary, and you go through a lot, whether it's an eminent domain or natural disaster, none of those are fun to go through. But the 1033 exchange can be a huge lifesaver so that you don't have to then suffer from all sorts of unknown tax consequences that you didn't expect. So first of all, you've had an involuntary conversion. In this case, we're really focused on the LA fire, so it's a natural disaster, but it could be an eminent domain. And you're going to reinvest by either rebuilding, repairing, or going out and buying another property. So you have certain timelines, certain deadlines you have to worry about when you're going through the 1033 exchange process. The deadlines or timelines are much, much easier to deal with than they are in a 1031 exchange. For those of you who have gone through a 1031 exchange, you know that when you sell your property, you've got 45 days to identify what you're going to buy, an additional 135 days to actually complete your exchange, for a total of 180 days. That's a very short time frame, and to try to find property and identify within 45 days is tough. That is not the case with a 1033 exchange through an involuntary conversion. You have a much longer time frame to reinvest. Excuse me. So if you're going through an eminent domain process, let's say the eminent domain occurs, in January of the current year, you're going to have the rest of that year plus 3 more full years to reinvest. So for example, we're recording this in 2025. So you're going to have the rest of 2025, then you have all of 26, 27, and 28. Your deadline for an eminent domain exchange or 1033 exchange would be December 31st, 2028. Long time to reinvest. We're really focused on natural disasters today. So a natural disaster 1033 exchange is not quite as long. You would again have the rest of this year that it occurred in. So for example, in 2025, the LA fires occurred in January and throughout February. So you really are going to have all of 2025, and then you're going to have the rest of 2026 and 2027. So almost 3 full years. So it's the current year plus 2 more years. And your deadline is going to be December 31st, 2027 to make the reinvestment. So still quite a long time to look for property and then reinvest or rebuild, whatever you choose to do. However, especially with the LA fires, there were a lot of buildings destroyed. There are going to be all sorts of obstacles to overcome. There's going to be simple problems that are not so simple, such as finding a builder, contractor, developer who has the time to go out and rebuild your property or build another property or what have you. So 2.5 to 3 years may not be enough because of all these other ancillary issues that are going to pop up and make it challenging. So with a 1033 exchange, it's not uncommon for the property owner to have their tax advisor, their legal advisor, write a letter to the regional director of the Internal Revenue Service, explain the problem, explain the disaster, explain what has happened, explain the challenges, and ask for an extension of time. And we've seen a lot of clients who've got an extension, so they actually have a full 5 years to reinvest. So I would suggest everyone do that this time around if you're suffering from the LA fires. You can't get an extension if you apply for it after your deadline. So I would have your tax or legal team immediately file for an extension for your 1033 exchange and find out what timeline you're going to really have. And you'll probably get a full extension to the 5-year mark. The other question that comes up a lot is, well, what's like-kind property? And for those, again, who have dealt with a 1031 exchange, the definition is very broad. But that is not the case for a 1033 exchange transaction. So with an eminent domain where the government has taken your property, the definition of like-kind property is pretty close to a 1031 exchange. Not exactly, but it's pretty darn close. So with an eminent domain, you got a lot of leeway there in terms of what you can reinvest in. But again, today we're focusing on natural disasters. So with natural disasters, it's very different. The definition of like kind is similar or related in service or use. So if you have a primary residence, the primary residence would have to be replaced with another primary residence. If you have residential rental property, so it could be a single family property that you've rented out, it could be a multifamily property that you rent out, that has to be replaced with other residential rental properties. So the definition of like kind is much narrower when it comes to a 1033 exchange transaction. The reinvestment requirements, this is actually a really neat thing. You know, with a 1031 exchange, you have to trade equal or up in value. You have to reinvest your equity. You have to replace your debt, and in order to defer all your taxes for the most part. That's an oversimplification, but with a 1033 exchange, none of those are true except for trading equal or up in value. So let's say you have a $5 million property that is destroyed from the fires. You get a $5 million check from your insurance company. All you have to do is buy, well, either rebuild, a lot of folks will rebuild, or buy another property of $5 million or greater. So you replace or reinvest the proceeds that you received from the insurance company, and that's considered tax deferred. So you don't have to reinvest your equity, the cash that you got from the insurance company. All you have to do is buy a property of equal or greater value than what was destroyed or what you lost, the claim that you filed. You do not have to reinvest the cash. So literally, if you could find replacement property and you could pay all debt with that, you know, 100% financing somehow and pocket all the cash, it would still be tax deferred. That is different from the 1031 exchange where you have to reinvest all your equity. So it's one of the neat things with the 1033 exchange is you can actually pull some or all of the cash out and not incur any kind of tax consequences. And I keep going back and forth between 1031 exchange and 1033 exchange, and there's a reason for that. First of all, they're very similar, but they're also different. But in some cases, you can do both, or you can convert to one versus the other. With 1033s, you have a much longer time frame to reinvest, but the definition of like kind is a little narrower, or in some cases, much narrower. With 1031s, you have a much shorter timeline to reinvest. You've got the 45 days and the 180 days, but you have a much broader definition of like kind property. So the question is, you know, can you opt to do a 1031 exchange instead of a 1033 exchange? It depends. First, if you're doing an eminent domain transaction, in most cases, you're entering into some kind of a contract with a government agency to sell the property, whether it's, you know, voluntary or being forced or what have you. But in a lot of cases, it's through a contract. So the contract means you can assign the contract to a qualified intermediary, and you can convert that sale into a 1031 exchange. Or if they've threatened you with eminent domain, you can also do a 1033 exchange. So with eminent domains, you have more choices, more options, depending on what is right and best for you and your goals and objectives. So you have to look at the the differences between the deadlines and the timelines, and you have to look at the differences between the definition of like-kind property and determine which is the better way for you to go. With a natural disaster, there is no sale of real estate. There's no purchase and sale agreement. So there's no contract that can be assigned to a qualified intermediary to convert it into a 1031 exchange. So the actual natural disaster and then the insurance reimbursement cannot be structured as a 1031 exchange because the property doesn't exist anymore. There's no purchase and sale agreement. There's no ability to assign that into a qualified intermediary. So that would have to be a 1033 exchange transaction. However, we're going to talk more about it in a minute, but the property, the dirt still exists. Now, the dirt might be able to be structured as a 1031 exchange depending on what the property was held for. If it's your primary residence, it's not held for rental, investment, or business use. So the 1031 exchange would not apply in that case, but you might qualify for the 121 exclusion. That's the $250,000 or $500,000 tax-free exclusion, depending on whether you're married or single. But if it's held as rental property, let's say it was a single family residence and it was rented out, so it's rental property, and you sell the dirt to someone else, that's a sale of investment property. That could be structured as a 1031 exchange transaction and gives you a much broader definition of like kind. So there's a lot of moving parts there. It's really important you sit down with your tax advisor and or your legal advisor. There's a lot of exceptions in both 1031s and 1033 exchanges. So you have to understand those. We'd be happy to chat with you as well. And then, you know, the end of the day, we want to make sure you're making the right and best decision for what's right for you. The other thing to keep in mind is with a 1033 exchange, you do not have to identify the replacement property. In a 1031, you do have to identify what you're going to buy within 45 days after the sale closes. With a 1033, there is no identification requirement. So you don't have to identify anything. All you have to do is make sure that you acquire the replacement property of equal or greater value within the appropriate timeline, whether it's an eminent domain or a natural disaster. So that's one of the positives there. In a 1031 exchange, you need a qualified intermediary. In a 1033 exchange, there is no requirement, there's no capacity for any third party to hold the funds. So there is no qualified intermediary needed. There is no capacity to use a third party. You just, as the property owner, you're going to get an insurance check or a check from the government if it's eminent domain. You can deposit that in your own account. You do not have to hold it in a separate account. Just put it in with your regular funds if you want. If you want to keep it separate, doesn't matter. It doesn't matter what you do with the funds. You can take them, you can use them, you can do whatever you want to do with them. And again, the only requirement is you buy replacement property of equal or greater value, and you don't have to reinvest the cash if you don't need to. Obviously, you're probably going to have to put some cash down and then get financing for the balance. But if you can pocket some of the cash, it does not create a tax consequence. But again, you don't need a qualified intermediary or anything like that. Where it gets a little confusing is on the tax reporting side of the equation. So if you decide to do a 1033 exchange, how do you report that on your taxes? There is no IRS form for reporting a 1033 exchange. I have seen some tax advisors attempt to use the 8824, which is the form that you use to report a 1031 exchange. Doesn't work really well for a 1033 exchange. You can kind of get it to work, but it's a little awkward. In most cases, what I see tax advisors do is they'll add a memorandum or a schedule or something at the very back of the tax return. It's just a narrative as to what happened. It describes the eminent domain or the natural disaster, describes the circumstances. You probably don't want to be too brief, but you probably don't want to go into too much detail. Somewhere in the middle, talk about what happened, disclose the transaction, and then at the very bottom you say, and you are electing to do a 1033 exchange, or you're electing to defer the taxes pursuant to section 1033 of the Internal Revenue Code, something like that. Then, and that would be done in the year that the eminent domain or the natural disaster occurs, and it's really your election to do a 1033 exchange. And then once you actually complete the reinvestment, the year in which you complete the investment, I would do the same thing. I would do another memo or schedule that discusses what happened, discusses that you've reinvested. Again, don't go too brief, don't go too detailed, but enough that you're saying, this is what happened, we're now done. Those don't get really picked up by the IRS's computer system because it's not really data, it's a narrative, but it is in the tax return and it shows that you've elected 1033 exchange treatment. It discusses what happened, and it also discusses once it's completed. The final thing I wanted to leave you with in these cases is when you file a claim with your insurance company, they're going to assign insurance company adjuster for your particular situation. They're going to evaluate the loss and determine what the claim is worth, and then of course you get a check. But don't necessarily just stop there and take what they tell you it's worth. There are ways to deal with that. And what a lot of folks aren't aware of is a person that's called a public insurance adjuster. The public insurance adjuster represents you as the property owner or the policy holder. They're an advocate for you, and they're going to advocate for your best interests as the insured. They're going to read your insurance policy to see what your coverage really is. They're going to look at the casualty loss. Well, it could be eminent domain, but probably a natural disaster. And they're going to look at the situation, and if it deserves more, they're going to go to bat for you and go after the insurance company and negotiate a higher settlement for you. And that is critical to have somebody in your corner fighting for you. The insurance adjusters we've worked with only get paid if you get more money. So for example, in the LA fires, we're hearing a lot of people are getting, give or take, about a 60% return or reimbursement of their loss. That probably is not adequate. If the insurance adjuster, the public insurance adjuster comes in and says, no, we think you really deserve 80% or 100%, whatever it might be, they usually get paid a percentage of the additional insurance proceeds you receive. So if you get a check for 60% and they get you up to 80%, it's a 20% increase. They get compensated just on that 20% because they went to bat for you and got that. Highly recommend at least talking to a public insurance adjuster and see what the chances are there that you can get additional funds. So this has been a quick whirlwind tour. We just want to get the information out there, especially for those of you who've suffered so greatly from the fires in Los Angeles and Southern California. Happy to chat if you have any questions on the 1033 exchange process. Just give us a call. Happy to help you out. Thank you so much, and I hope you have a full and fast recovery.